No stock is talked about more these days than NVIDIA. Since we first invested in the stock nearly a decade ago at a $40 billion market cap, it's now become one of the biggest companies in the world today. Two questions here. One, is there much upside left? Two, are we in danger of losing our gains? The answer to both these questions can be found by examining valuation. Today, we're going to teach you everything you need to know about valuing NVIDIA, starting with a simple example. So let's pretend I have a successful food truck that I want to sell you. The truck brings in $50,000 a month or $600,000 a year. I offer to sell it to you for $600,000. Is that a good deal? So the knee-jerk reaction here might be to say, well, it brings in $600,000 a year in revenues, and I'm purchasing it for $600,000 a year, so I get my money back in a year. No, you won't. That's revenue, not profits. Now, we only used revenue-based valuation methods, like our simple valuation ratio, if a company is not profitable. Now, it just so happens our food truck is profitable at a profit margin of around 30%. So that's $200,000 a year in profits. So it would take you 3 years to get back the $600,000 purchase price. All things being equal, of course, but what if you had a bad case of E. coli? Or what if Andrew Zimmern came by and visited the food truck? As you can see, the value of our food truck will fluctuate based on external factors that are not within our control. And so does NVIDIA. So a stock is partial ownership in a company like a food truck. If a food truck earns $200,000 in profits per year, and the price of that food truck is $600,000, the price to earnings ratio for the food truck would be 3, $600,000 divided by $200,000. So if that food truck had 100,000 shares, each of those shares would represent partial ownership and be worth $6. It would also be entitled to $2 in earnings per year. So now you take the $6 per share, divide it by the $2 in earnings, and you get a price to earnings ratio of 3. So now let's do NVIDIA. What's NVIDIA's price to earnings ratio? Well, we can take the current price per share of $120, and we can divide that by earnings per share over the past trailing 12 months of $2.56. So 120 divided by 256, you get 47. Is this high or low? Well, we need some benchmarks to compare that number to. What does price to earnings look like for the average stock? How does this differ between growth and value? Useful comparisons might be to compare NVIDIA's price to earnings ratio of 47 against the market, possibly against other tech stocks, against its own historical values. And when we look at the price to earnings ratio for the S&P 500, it's quite interesting. This chart here shows us two values. In blue, you have price to earnings ratio calculated over time. So this is for the largest 500 companies in the United States. Price to earnings ratio is 30. So NVIDIA is significantly higher than that at 47. But the other line here that's charted is also rather interesting, and this is referred to as the CAPE ratio, or the Shiller PE, or the PE10 ratio. And basically, the acronym CAPE stands for Cyclically Adjusted Price to Earnings Ratio. And all they've done here is taken the trailing 10 years of earnings and used that to calculate PE. So it smooths everything out. And this ratio is currently quite high at 38, leading some to believe that the market is due for a correction. The key takeaway here is this, that when the market's price to earnings ratio adjusts, so will the earnings ratios for individual stocks. Now, we still need an appropriate benchmark for our NVIDIA PE ratio of 47. So what we can do is possibly use the NASDAQ 100. So this would represent some of the largest tech firms in the world. The ratio is calculated by the venerable Wall Street Journal. So a large tech firm, therefore, ought to be valued around 33. You see the numbers here. And their calculation of the S&P 500, you see, is quite low at 25. This brings up another very important point. You'll get 10 different values when you go out there searching for this number. So it's very important that you calculate this yourself so that you understand the mechanics of how it works. That's what we're going to do today. Now, when we consider a more appropriate benchmark for NVIDIA, that might be semiconductor stocks. And I took this table from Stock Analysis. It shows the collection of 66 stocks that make up the semiconductor industry. This is according to industry classifications that are set in place by companies like MSCI and S&P Global. And here you see the average PE ratio for semiconductor stocks sitting at around 54. Now, it's important to note here that this is a weighted average PE, so the larger companies are going to command more of an impact on the overall number. And when we start going down this list, we see NVIDIA at 47, so that's good. That validates the calculation we did ourselves. Then we see Broadcom at 171, so clearly that's skewing the average a lot here. Other highly valued names include ARM and AMD, and Qualcomm is actually quite cheap. We're actually going to look at Qualcomm in a coming piece, so make sure you're subscribed to this channel. So let's look at why Broadcom might be so expensive. We'll just do the math. We take the price of the shares, $221. We take the trailing 12 months earnings per share, $1.22. We get a PE ratio of 181. So it's roughly in line with what Stock Analysis is showing us. The reason this is so high, because there was a one-off quarter of losses. You can see the data taken from the right. I think that's from Guru Focus. So it's always important when you're looking at this stuff to cross-check your numbers and data against different vendors, because oftentimes there are a lot of mistakes in the data. So we have that one quarter of losses that's bringing down this number, but then we have very high growth expected for next year. Well, how high? Well, you can go to Yahoo Finance and pull up these interesting tables that will show you what analysts are forecasting. You actually get the low estimate, high estimate, and average estimate, so we can calculate what's called a forward price to earnings ratio. This is taking into account the growth that analysts expect for next year. So take that price of $221, we divide it by the average forecasted earnings per share next year of $6.35. So significantly higher. We get a forward price to earnings ratio of 35, so much more in line with the benchmarks that we've been looking at. Now, of course, we're here to talk about NVIDIA. I just wanted to use that example to show you how next year's forecast will affect the valuation of a company. So when we consider NVIDIA's valuation, the earnings per share number that drove over the past trailing 12 months, that drove our price to earnings ratio of 47. We see here some consistent growth in earnings per share. And when it comes to key drivers that are affecting this, it's very important to note these two charts here. The one on the top shows the growth in gross margin for NVIDIA. Very significant, which consequently you see impacts their operating margin. In other words, profitability for this company has increased significantly. Why? Well, the pricing premium that this firm gets to command because everybody wants their product and they're willing to pay anything for it. That's not going to last forever. How long can NVIDIA command that price premium? What happens when you start to see margin weaknesses? Well, the recent news about DeepSeek certainly relates to these questions. We'll talk a little bit more about that. But when it comes to how NVIDIA might see growth in other areas of their business, it's very important to note that data center makes up over 80% of their total revenues. When you look at the other segments, there's not too much happening. Auto, as you can see here, is growing, showing some reasonable growth, and NVIDIA expects to harvest a lot of value from that segment. But their other two segments, gaming and professional visualization, aren't really showing any sort of consistent growth over time, and this chart here shows the overlay of visualization and auto against gaming, and you can see these segments are very, very small. So for them to have an impact on the top and bottom lines, it's going to take some real growth. Data center is NVIDIA's cash cow, and the question is, can other segments show growth to offset the plateau of data center revenues? Well, this rapid growth for data center is not going to continue forever, and this time is not different. So some of the risks NVIDIA faces. Remember, we talked about external risks for the food truck. Well, you have market risk. As we said, valuation for all companies falls across the board. You have industry-specific risks, so perhaps semiconductor stocks see a valuation adjustment across the board. Regulatory risk, we know the new administration can impose additional constraints on the company. There's company-specific risk. What happens if Jensen gets hit by a bus? These are things you need to think about. Black swan events that you won't see coming. The unknown unknowns, as Rumsfeld would say. So what we said a year ago when we looked at NVIDIA's valuation, we said, we've made a reasonable case to show that NVIDIA isn't overvalued based on expectations for next year. We said that just about a year ago, and at that time, NVIDIA had a price-to-earnings ratio of 95, significantly higher than it is today. The analyst midpoint for last year was $22 in earnings per share. Now, they had a 10-for-1 stock split, so you need to adjust that. So the analyst midpoint was actually $2.20 per share. The actual came in at $2.53 per share. So consequently, the share price reacted accordingly. It was up 91% since a year ago, compared to a NASDAQ QQQ gain of 23% over that same time frame. Why? Well, because it deserved that gain. Here you can see the new 4 data points. This is the earnings the company saw over the 4 quarters of that year. And in this case, the fundamentals do match the price action. So now let's do that same exercise for NVIDIA today, the forward price to earnings ratio. NVIDIA has a price per share of $120. The average earnings per share forecast estimate for next year would be $4.45. That gives us a forward PE ratio of 27. So what we can conclude from that is NVIDIA isn't overvalued based on analyst estimates of what's expected for next year. As I said, there's lots of external factors that can come into play here, but if everything remains roughly the same, then NVIDIA wouldn't be considered overvalued. Now, what we can then do is a sensitivity analysis and say, let's assume that forward price to earnings ratio stays the same at 27. And then let's assume that the analyst low-end estimates come to fruition. Well, the price of shares would then drop to $103 per share. Now let's say they meet the expectations of the most optimistic analysts at $5.95, the price would rise to $160 per share. Now, all this valuation analysis in $5 might get you a couple crispy tacos at Jack in the Box, but it's sure better than the absolute shit we see being peddled out there by all the instant analysts. Perhaps a bigger concern here would be the market overheating. When we think about market risk, and there's really 2 trains of thought here. The first is that AI is now bringing upon us a golden age of abundance. Earnings are going to skyrocket for companies, and that will bring the broad PE ratio back in line. Here you can see market earnings for the S&P 500 charted over time. Or earnings growth doesn't happen fast enough, and the PE ratio returns to average. And of course, what always seems to blindside everyone is when a black swan event happens, and based on geopolitics and what you see in the world going on these days, it's not unreasonable to think that a black swan event could happen. Some closing thoughts here. Forget about NVIDIA for a second. Is this method of using PE ratios more intuitive now that we've gone through some basic examples? It certainly should be. They're very sensitive to changes in margins, as we demonstrated today, and of course, changes in earnings. That's why every time you have earnings from a company, typically you'll see a lot of price action. That's when everybody's adjusting their models. Quarterly fluctuations make these measurements much less useful, and I think AVGO is a good example of that. For NVIDIA, if demand subsides, their pricing premium is going to dissipate, gross margins are going to fall, profitability will drop, earnings per share will drop, and valuation will drop as well. As DeepSeek has suggested, we perhaps don't need as much hardware as we think. However, the best thing to do there is to wait for the dust to settle a bit, for all the hysterics to die down. Now, we only exit disruptive tech stocks for 2 reasons, really. If growth stalls or our thesis changes. So for us, we're just keeping an eye on the company's continued growth. And of course, profitability is a key metric to watch going forward. Now, when it comes to Broadcom, some people are saying it's the next NVIDIA. Well, we did a piece on that, I think about 6 or 7 months ago, that talked about that. You should give it a watch next. Thanks so much for taking the time to watch this today.